Hello, viewers out there. Welcome back to Coins Tutor, your number one YouTube channel for crypto educations and updates globally. It's your boy Simi Nagachi here with another banger video. And on this video, I'm going to be talking about Module 5. We've been talking about Module 1, 2, 3, and 4. Now, we're going to talk about Module 4, 5. If you are new to this channel or you are new to this training, you don't know what I'm talking about, let me tell you, let me just brief you. This YouTube channel was formerly known as Dintech Television, but we decided to change the name to suit what we do exactly on this YouTube channel, which is crypto education and crypto updates. And to actually celebrate the community, to give to the community and welcome our brand new name, we decided to launch and host a 1 month free crypto course. Like it's a full packed crypto course. You're going to be learning for free for 30 days, and we're already on module 5. It's divided into two. The first part is theories. The second part B is going to be all about practicals, where we do on handle all the tradings and all that. So on the part A, we have module 1 to 12. It's all about theories. When you're not grounded on theories in anything you want to learn, you're going to have issues with the practicals. So as an experienced teacher, I decided to make my curriculum in such a way that the first to 12 modules are going to be theories. So you need to know everything you have to know before you get started with the trading. Okay, do well to follow all the modules serially. Don't skip any module, because if you skip any module, it's going to be difficult for you to fully understand the next, as subsequent modules build on previous modules. But before I dive deep into what we have for this module, I'd like you to please subscribe to my YouTube channel, give me thumbs up, share the YouTube channel links with your friends and family. That's the least you could do for us. All right, having said all that, before I see any more subscriptions and all that, let's go into the business of today. I like subscriptions, but let me dump that. Anyway, we have a business before us. Our business on this video is trading. So Module 5 is talking about trading on this our course. So on this topic, we're going to be looking at five subtopics. We're going to be looking at vocabulary. We're going to be looking at spot and futures trading. We're going to look at buy versus sell on spot. We're going to look at buy versus sell on futures, and then lastly we look at supply and demand. Yeah, most of you who did economics, you're going to be like, supply and demand in trading? Yeah, of course, that's what trading is all about. That's what moves the market. Sipping sipping water. Okay, so vocabulary, we have three major concepts in the crypto space. And these three major concepts is like, if you're a trader, there's no way you would escape these three concepts. You hear it daily, you're going to be seeing it, you're going to see people talking about them, but you need to really understand what it is. So we have volatility, we have liquidity, and we have volume. So what is volatility? Simply means the rapid and significant price fluctuations of cryptocurrencies, creating potential risks and opportunities. High volatility leads to rapid market price fluctuation, allowing traders to quickly secure profits or incur losses. You may say incur losses. I know most of you don't want to hear incur losses. All you want to hear is that I came into the crypto space, I bought with $100 and then I made $1 million. No, you should always be prepared for whatever happens, because in trading there's a loss, there's a profit. But what matters is your profits should outweigh your losses. But if your losses outweigh your profit, then something is wrong. You need to sharpen up. You need to change a trading pattern and then go for something that works better. Okay. So on the other hand, low liquidity leads to slow market price fluctuation, enabling traders to slowly secure profits or incur losses again. I'm here again with incur losses. All right. So the simple thing is, volatility, right, is the movement of the market. It could actually happen speedily or slowly, but there are things that trigger volatility. Like when you talk about volatility being high, major news releases could actually trigger it. You could hear that Donald Trump did this, blah 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 blah, and this is happening. And you hear that Iraq is having silent attack against Israel, and lives were wasted. You hear that in Japan. No, no, let me not call any country. You hear that in so country, something happens. There are earthquakes. There are stuffs like this. Major news releases. There's something we call FUD in crypto. Major news releases that causes about that brings about FUD, that's fear, uncertainty, and doubt, is definitely going to have the market dumped hardly, and that dump is going to happen very speedily. That movement is called high volatility. So if you have good news, major news releases in the crypto space or by way of economic data, and the news is good economically, it's going to also trigger very high move in the market to the upside. So even if it moves like that to the upside, as far as it moved with speed, it's called high volatility. So volatility, it's not about where it's moving, whether the market is moving up or down, it's about the speed. So it could be high, it could be low. So whether it moves speedily to the upside or speedily to the downside, volatility is volatility. Okay. So when it's high, traders could actually easily book profits or book losses within a very short period of time, or when it's low, traders could actually book profit slowly or book loss slowly. So that's how volatility works. Now let's talk about liquidity. So basically, liquidity refers to the money or capital that flows into any kind of crypto project from traders or investors, retail traders, from whales, institutions, anybody. So this capital enables the easy buying and selling of or the project's coin or token without causing drastic price changes. Where, for instance, you see all these what is it called? Solana Degent. You just throw in $1,000, oop, the price jumps to heaven. Some of you, if you've traded on an exchange called MEX before, some of these very low cap coins, if you try to buy by market price, the way it usually jumps is crazy. That's because the liquidity is low. So for the price of a coin or a token to be stable when people buy it, for it to for people to easily buy and easily sell without the price jumping unnecessarily high or low, the volatility has to be strong, at least very, very strong. Okay, so when volatility is high, it's good for a project, but when it's low, that project is not strong, is not good. Okay, so high liquidity, so I say volatility, liquidity, don't mind me talking about liquidity. Sorry for that mix up. So high liquidity ensures that there is sufficient volume of assets being traded, okay, making it easier for traders to enter or exit positions. So you need liquidity to be high. Any project with high liquidity is a strong project. But when you say project with low liquidity, that project is weak and is not attractive to investors. When we get to fundamental analysis, I'm going to expand this where we can even do in advanced level. Liquidity is a whole thing on its own. We can even do um, liquidity to market cap ratio, all that calculation, mathematical calculations, and all that. So let's look at volume. Volume in crypto trading refers to the total number of assets traded within a specific period. High volume shows how strong a project is, and vice versa. That means low volume shows how weak a project is. Now, if you have Omikami, there's a token called Omikami, and today people bought the overall purchase of Omikami today was let's say 100,000 units of Omikami was bought totally by different investors across the globe. That's a volume that came to Omikami. If by tomorrow people bought 200, like the total purchase that happens, like if in 24 hours the total purchase that happened on Mikami is up to let's say 200,000, then we're going to be saying that Omikami recorded 100% volume increase in the past 24 hours. So volume is about the number, the quantity, the size of assets that traders purchase over a period of time. So volume could either be high or low. When volume is high, it means that more traders are buying the token, the supply of the token in large quantities, in larger quantities. When volume is low, it means that traders are not buying in larger quantities. So let me relate this and this. When liquidity is flowing into a crypto project more in a specific period of time is actually going to drive, is going to result to high volume. So if today, don't forget, liquidity is money, liquidity is capital. See it that way. Liquidity is money, capital that flows into a project from different kinds of investors. It doesn't matter whether it's whales, retail traders, institutions, hedge funds. It doesn't matter. What matters is it is money or capital that flows into a project. So if liquidity of a project at any specific period of time is higher, it's also going to result in higher volume. If liquidity is low, it's going to result in lower volume. So both of them work together. Okay. Now, if volatility is high at any period of time, probably to the upside is high. The market is moving very speedily to the upside. It usually attracts newbies. That's where you see people FOMOing and jumping on green candles, chasing green candles. It can also be disastrous, but play cautiously. Okay. So I think you understand these three. I've been able to explain them. You know, I'm a good teacher. Yeah, I know, and I know you know about that. Okay, so we're going to be talking about trading. We're still talking about trading. Okay, and for trading, I said here that trading is about purchasing and selling cryptocurrencies via spot. Okay, via spot futures or margin trading in order to take advantage of volatility or market swings. So when volatility, whether it's high or low, you just want to buy, especially when you're on spot, you just want to buy low price, you want price to go high and you take profit. For futures, you just want to buy both ways, whether it's going up or down. Just do your analysis, know what to follow, use your leverage, do your thing, and you make money or you make loss. I know I know you anyone hear that one. Yeah, you make loss. Both of them. So you could make one thing is a two-way thing, it's a two-edged sword. That's what trading is. Is that you're making profit or you're making loss. You cannot escape any of both of them simultaneously. Okay, so margin trading we're not going to talk about is we're going to dwell much more on spot and futures trading. So futures trading, we're talking spot trading first. This involves the immediate buying or selling of actual cryptocurrencies at the current market price. In spot trading, you own the crypto directly. That like if you're trading in spot, what you do is you basically buying low and you're expecting market to go high so that you take profit, right? If you buy Bitcoin at 50,000, it gets to 60,000, you made a profit of $10,000 and you want to sell. So buying your Bitcoin low, it's your decision to know when to sell, how long you're holding it. But the summary of everything we do on spot is you just want to buy low and you want to hold for more gains. So the longer you hold determines whether you're going to make loss or you make profit. Now, when you trade on the spot market, as long as you're holding strong projects with good, strong community and genuine developer, right? Even if market goes against you, let's say you buy Bitcoin at 60,000 or 50,000 and Bitcoin dumps to 30,000. Even if market dumps like that, you're not going to have a permanent loss. In trading, we have two kinds of losses. We have permanent and impermanent. Permanent is the one that when you die where your money don't go. Your money is gone permanently forever. Then impermanent is the one that you still have hope that, oh, one day this trade is gonna come back to me, at least to my entry. Let me break even, or at least like break even means to get your capital at least, or get just something small. So in trading, when you buy like that, even if you bought Bitcoin at 50,000 and then it dumps to let's say 30,000, since Bitcoin is a very strong project, you've not lost your money entirely, right? If Bitcoin returns to 50,000, at least your money is going to be out. You've broken even, or even if it gets to 60,000, you're going to make profit. So it's all about how long you hold it. So not really how long you hold it, newbies, so that you don't misinterpret it. It's all about patience. Patience is needed in trading. So as long as you're holding a good project, right? If you trade it, it's bad. You know the project is strong, strong in quotes. See the way I'm emphasizing it. You hold the project for market to come back up because market would always dump against you. So basically, in sport, you buy low, you want to sell high. If you buy low, it goes lower than where you bought, and it's a strong project. Hold it for it to at least come back to your capital, and you're not going to be in loss. So, in sport, one more thing, you're holding real assets. It's more like digital aspect of doing your real estate. In real estate, you buy physical product, the landed properties. In sport, in the crypto space, you buy digital assets. You're holding it over a period of time. So, it's real assets you are holding. So, macroeconomic data affect what you are holding over a period of time. Okay, so let's talk about futures trading. Futures trading involves contracts where traders agree to buy or sell an asset at a predetermined price at a future date. So these contracts allow traders to speculate on the future price of cryptocurrencies without actually owning the asset itself. As oh, this my itself is okay, sorry, typographic error, I didn't space it. So it's actually, I don't want to say gambling. It's not gambling, but something more like that, more like you're speculating, right? You know, in trading, they said we should not say you're predicting, but it's more like that. It's more like predicting a price. You're saying, oh, Bitcoin is at 60K. I see that price because something is going to happen. It's going to go down to 40K. So I want to sell. Oh, Bitcoin is at 40K. I see that it's going to go to 100K. So I want to buy. So in futures, you're not holding any real asset. What you're just trading is basically contracts, just mere contract. So you go into contract with the exchange, centralized exchange you are, or decentralized exchange you are trading with, and you are bidding that this asset is going to rise at specific time. And you know, when you believe it's going to rise, you buy and wait for the rise. And if the rise goes in your favor, you're going to make money. But if it falls below where you entered, you're going to have impermanent loss. But if it keeps falling to a level where your leverage, your contract has been breached, you're going to be liquidated. You go die where you understand me. Your money is going to be gone. So in features, there's a specific period of time. There's a level to which your floating loss will get to, and it becomes permanent loss. That means your capital, the amount you used to trade, is going to be gone for life. Okay, so let's now talk about that's the instance I just gave about sell. So if you also believe that a token or a coin is going to fall in value in futures, you can just go to futures and say, oh, I believe this one is going to fall in value. So you sell it. When you sell in futures, you're expecting that price is going to drop. So if you sell and price drops eventually according to your forecasting, or in quote, if you will, prediction, you're going to make money. But if it goes against you and then go to the upside instead of going down, you're going to lose money. And there's a level it gets to the upside, your loss ceases to be impermanent. It now becomes permanent loss, and you're going to lose everything. Okay, so on the futures trading, you can trade on spot trading. You can only trade one way. That means you only buy and expect price to rise so that you make money. It is this way because you are holding real assets, just like in traditional trading where you buy goods. The boutique man buys a pair of jeans for 10,000. He wants to sell it for 100,000 to Yahoo boys. You understand, he wants to make profit. And if he buys it for 10,000 and there are no more Yahoo boys to buy, and probably people Simeon wants to buy for 8,000. If he eventually sells for 8,000, he loses 2,000. So in sports, okay, all right. So on sport, you want to buy low and you want to sell high. So, but if you bought low and it's going lower, 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 deeper, 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 you're gonna be in floating loss. Hold if you're holding good coin, hold for as much as you can hold and break even. But on futures, you trade both ways. If you believe an asset is going to depreciate in value over a period of time, you sell it and expect it to drop. If it drops, you make profit. If it goes up against where you sold, you make loss. Goes to a certain level where your terms and condition of the contract get breached, you get liquidated. If you believe an asset is going to rise, you buy and wait for it to rise. If it rises eventually according to your forecasting or prediction, if you will, you make money. If it goes down against you, you lose money. So we're going to look at the next thing we have on our slide, which is actually looking at buy versus sell on the spot. So what it actually means, we're going to look at few terms. So buy versus sell on spot refers to acquiring digital assets with the expectation of future price appreciation for investment purposes or blah blah blah. So sell means to liquidate the asset. So when you buy an asset on spot, the price you bought Bitcoin at 30,000, the price got to $60,000. When you are selling it, it means you are selling to make profit. Just take it to be like the boutique man. It's a very simple analogy. You buy a pair of jeans for 10,000 and a Yahoo Boys comes to buy for 100,000. As you're selling, it's profit you're taking 90,000 naira profit. It's the same thing on spot, okay? So when we talk about sports, we have terms that we use on sport. We have the buy, where if you're talking about buy, you can say buy, you can say go long, you can say go bullish. Okay, bullish is the same thing as saying go long, just a technical way of saying buy. So long, go bullish. So these are the terms bullish, long, buy. They are used interchangeably. So in sport, just like I've overemphasized, you buy low and expect price to surge higher. When that happens, you sell off and take profits. So sell, short, go bearish. These are terms used for sell. So short is just a technical term for saying sell. Go bearish, just a technical term for saying sell in uh, selling on spot. So you sell off at a higher price to book profits, but before you can talk about sell, right, you must have already bought an asset on spot. You cannot be talking about sell on spot when you don't have an asset already you want to sell. Okay. But in futures, sell doesn't mean selling an asset you're already holding. It means it's just a contract you're signing. It means you're betting that an asset price is going to go down. So, but in sport, you're selling an asset you're already holding. It means you were already holding it, but the price, probably the price you see it now, you want to sell it and get off the market, whether in loss or in profit. So when you sell off at higher price, you make profit. But when you sell off at lower price from where you bought, you're gonna make loss. Okay, so we see bearish, you see short, you see sell. Those are the terms used interchangeably when we trade on sport. Okay, so this is a chart showing what a buy means, what a buy looks like on the sports on sport. So on when you look at a chart on a lower price like this, for instance, this is Ethereum chart showing buy versus sell on spot. So Ethereum price, as when I was looking at the buy, was at 1,824, right? So if I bought here and I wanted to sell here, the price here is around the price here is around 3,000. So I made so much profit. And if I sold here, which is gonna be second take profit, the price was around 4,000, which is huge. So on sports, if you, as far as you are selling above where you bought, the term you're gonna use is either sell or take profit. So when you hear sell on spot, it means the person is getting off the market. The person is selling off a real asset they were already holding. All right. So sell is more of a general language for selling of an asset, which means you could sell off in loss or you could sell off in profit. But then when you're selling above where you bought, that means you're taking profit. So you can comfortably say take profit. Okay. So we have keynotes here, and sport you buy low and sell high. So that's it. So let's talk about sell versus buy versus sell on futures. Let me sip my water. All right, buy versus sell on futures. On futures trading, buying and selling involves contracts that obligate traders to buy or sell an asset at a predetermined price and future date. Unlike spot trading, where you own the real you own real assets, futures allow traders to speculate on price movement without owning the underlying asset. Profits or losses depend on the price movement relative to the entry price, and traders can be liquidated if their positions lose too much value. I think I highlighted that before now. So in features, like I said earlier on, you're not buying any real asset, you're just betting on the value or the future price of an asset. If you presume that it's going to rise, then you buy. If presumably you think it's going to fall a specific period of time, you sell. So if it goes for you, you make profit. If it goes against you, you get impermanent loss. It gets to a point where the loss is now too much. Your contract is broken and you have permanent loss. And that's where you hear that people get liquidated in futures. So in futures, we still use long and go bullish for buy positions. Bullish, long, buy. They are the same thing. So if you believe the price will rise in futures, you buy and close your contract at a higher price for gains. Closing below is equal to permanent loss. So when we talk about sell in futures now, we look at terms like short, go bearish. If you believe the price will dump, you sell and close your contract at a lower price for gains. Closing above entry equal to loss, permanent loss. Okay, so we can see illustrations of the bull and bear. In trading, why we use bull or bullish for upward movement is that the bull is big, high, and optimistic, always looking to the upward. But I see this beautiful bear looking down, just a 4 Bitcoin hand carrying Bitcoin and pointing it to the ground, but the bull is pointing it to heavens and saying, "You are going to Mars, Bitcoin." Okay, so that's why we use bull and bear to represent up and down movement in trading. I hope that's getting very clear. So on our chart, this is what buying and sell, buy and sell versus sell looks like on futures market or futures trading. So in futures, you buy low and take profit high, then you sell high and take profit low. So in futures, this is futures. If I bought here, I want to take profit here. Now, if I also didn't want to take profit here, I could also take profit here, but for basics, just for the sake of basics, buy here, sell here, take profit here. So much money. It went in my favor. But if I bought here and it kept going down and down and down, I'm going to be in loss or get liquidated. So at this top in futures, this is Ethereum chart. If I'm betting that Ethereum is going to depreciate in value, is going to fall in price, then I want to buy at this top and then sell down. That's eventually what happened. Bought here and then sold here. So this is what buy versus sell on futures looks like on the chart. So lastly, we're going to talk about supply and demand. Where are the economics in the house? This is your topic. I know you like this one. Now, basically, in crypto trading, supply is the number of coins available, while demand is how much people want to buy them. Supply and demand greatly influence price movement. Okay, so in supply, in crypto trading, we can look at supply as sell. Like basically, in economics, supply is just the amount or quantity of product and services the owners, the industrialists, bourgeois, the business, the product owners are willing to present to the market to sell. While demand is the number of persons who are willing to, who want to buy. Let's not say willing. Want involves you have the will to buy, you have the money to buy, and you're willing to let the money go in exchange for the goods and services. Right? So we can actually look at the sell in this is our topic to be the supply in crypto. And then while we look at it as the number of tokens available for people to buy into, we also look at it as sell and then buy, like how many buys are coming into a crypto project. We also look at it as demand. Now, when supply, let's look at it from the quantity of tokens available before we look at it from the perspective of selling. When supply is really high, when supply is much, the demand is going to be low, and that is going to impact the price of the cryptocurrency. So when supply is high, the price of the cryptocurrency is definitely going to be low. Then let's look at supply from selling aspect. When people sell a crypto asset so much, when people dump it so much, it's going to impact the price of that cryptocurrency negatively, and the price is going to be low. But then let's look at buy. When demand is high, lots of businesses are trooping into the market and is bringing in lots of liquidity. You remember what I talked about liquidity? liquidity is just coming in high liquidity and then it's amounting to high volume, you're going to see that the price of that cryptocurrency is going to rise. It doesn't have any choice but to just rise. So supply and demand play a very key role in price price action when it comes to trading. So high demand results to high price or price growth or price surge or pump in the market. But high supply results to low price or dump in the market. So high demand is equal to high price, and high supply is equal to low price. I hope you got value for this video. I hope you spent your time well. This is just Module 5. On the next video, I'm going to be talking about a whole lot of stuffs on our Module 7. Don't forget to subscribe to our YouTube channel. Don't forget to give these videos thumbs up and share the YouTube channel link with your friends and family. I am your boy Agachi Simeon saying I love you very wonderfully. Have a very good day. Bye.